Hi, I'm Dr. Kevin Milo, and you're listening to the Physician Empowerment Podcast. At Physician Empowerment, we're focused on transforming the lives of Canadian physicians through education and finance, practice transformation, wellness, and leadership. After you've listened to today's episode, I encourage you to visit us at physempowerment.ca, that's PHYS, empowerment.ca, to learn more about the many resources we have to help you make that change in your own life, practice, and personal finances. Now on to today's episode.
Okay, so everyone is in. So welcome everyone. So to this brand new February edition, Physician Empowerment webinar. And we're very excited to have Jason Pisesky again. He's our faculty member, tax lawyer extraordinaire. And we're kicking off 2026. And they're saying that when you kick off a new year, the first day of the month, well, that's New Year. People are too happy, too drunk, and then they make their New Year's resolution. And then by the third week of January, people got really depressed because they got to pay their credit card debt. And February is when the rubber meets the road and people really start to think about their finance. And hopefully we're better than that. But there's a lot of planning, right? And so last November, there's a new federal tax update. And Jason was kind enough to update us at the Masterclass level. But this is an open platform. We'd like to, first of all, thank you, Jason, for making some time to share with us today. Just update us. What are the highlights of 2026 tax changes? How does it apply to us?
For sure. And the big update is that there wasn't any huge updates, which I think is not surprising. We had a big change in government. There's a bunch of things going on internationally. It did seem kind of like a flavor of let's stay steady as she goes. Mm-hmm. I mean, there were some new credits that were made, some revival of old credits. And they just announced a couple of days ago, actually, Wing and I, you were talking about it, the EV credits for some electric vehicles. Those have come back. That wasn't in the announcements in the fall, but kind of this, it's almost like we live in and we're seeing it out of the States, like a constantly evolving state of forever updates on things.
Yeah.
And again, there was also a moderate tax cut in the middle tax brackets, which, is always a welcome treat. But I don't, that won't be a huge change for lots of taxpayers. But for those in the middle tax bracket, it comes out to $500 or $600 sometimes. Yeah, I'm just trying to think of some of the, there were some more niche changes where they, went after some specific tax planning techniques. Most of those had fallen by the wayside anyways, because they've been deemed kind of aggressive by CRA in the past already. So most taxpayers had abandoned them, but the government felt they needed to come up with specific rules. Yeah, was there anything that stuck out from you at our masterclass when we talked, Wing, that you wanted to dive deeper into? Otherwise, I thought it might be a good opportunity to start of a new year. I'm sure everybody's getting emails from their banks right now talking about, you should contribute to your RRSP. The RRSP deadline is coming up. And again, I thought that this would be a good juncture to, there's been a lot of changes in the tax advantaged accounts available to Canadians. I thought this might just be a fun opportunity to talk about them, make sure people know what's there, maybe a bit of a refresher, and for once in our lives, let's talk about it at the start of a year instead of in December, about all the different
being all stressed out and so I could have done this and that, right? And so instead of fancy schmancy tax plans that ended up with AMT, let's talk about down to earth, salt-worthy, kind of the basic tax savings accounts, right? Or TFSA, RRSP. So I think there are 5, right, that we kind of chit-chatted about. So I think we're going to talk about RRSP, RESP, TFSA. There's a RDSP, right, disability, and FHSP. Those 2 are new to me. And we all know people who were first-time buyers, right? Our kids definitely in that zone. So it's good for us to learn. So let's go right into the most common RSP.
Yes, that's the one that I don't have any stats in front of me, but I feel a huge majority of Canadians have an RRSP with something in it. A lot of the companies in Canada, they'll offer matching programs. You put in 5%, we'll match 5%, or
not our hospitals.
not
Not Alberta Health, at least.
You haven't heard of that from the health agencies and RRSP matching program?
No, not from Alberta Health.
Yeah, we don't have to dedicate a huge amount of time to them because they are so common. But I think it never hurts to go over the basics. I'm a big fan of refreshing the basics, and so yeah, the RSP, registered retirement savings plan. The good thing about all these programs is, the answer is sometimes hidden right there in the name. So retirement. This one is focused on retirement. Interestingly, there's actually no age limit to opening up an RRSP as long as you have what's called earned income. Generally, that's kind of going to be salary and things like that. So, if you're a very, very forward-thinking 13-year-old who has their first job at the corner store, in theory, you start to be eligible to contribute to an RRSP. And so, from the tax side, the way RRSPs work is, of course, you get that deduction when you contribute to it, and then when it goes in, it gets tax sheltered growth. The idea being that, hey, one day I'm going to take that out and I'm going to hopefully be in a lower tax bracket. And that's where the savings comes, that arbitrage between, being a high or top bracket taxpayer to then being potentially, hopefully a low or no tax bracket individual when you take it out 20, 30, 40, 50 years down the line. Yeah. And the limit is tied to your earned income in the year, 18% of the earned income up to a cap. The cap is I think it's like 33,000 this year in 2026. The bank, if they're emailing you right now to make contributions, that's going to be tied to last year's number. Just an interesting quirk of RRSPs where they give you kind of a grace period to top up from the prior year's number. And so again, probably multiple reasons they do that. One of them being some people get year-end bonuses that are paid out in late December or January, and so giving people the opportunity to get those into their hands and contribute them if that's what they want to do. Yeah. So
right. So then for those of us that started as residents, we have salaries, so that would be T4s. For those of us that already started practice, and some have whose accountants always say do a T5 or do a dividend bonus, then that doesn't give you any RSP, correct?
Correct. Yeah. So again, it's all that'll be a sitting with your accountant and understanding that benefit and the give and take of, hey, paying a dividend means lower personal tax, but some more corporate tax versus paying a salary. You get a write-off for that in the company, and then you pay higher tax on the withdrawal. But if you're going to use your RSP, and so again, that's what that important conversation is with your financial planner, with your accountant. Of if you like the idea of RRSPs, what they offer, that deduction, it's a great deal. If you think you will be retiring, if you're Wing, and every time I talk to Wing, it sounds like he's never going to actually retire, I'm not sure RSPs are a great idea for him.
It's a present continuous future tense.
But there are some neat quirks in the RSP as well, whether they interest the people on the call, I'm not sure. There's the home buyers plan, which allows you to withdraw. Used to be, I think it was 35,000, but they recently boosted that as some of their initiatives to help people purchase their first home. So I think it's $50,000 now.
Wow, that's amazing.
Actually, I think it's 60. And I'm looking at my notes here, 60,000.
60,000 already. So you can just pull from RSP and pull 60,000 out to buy the first home?
Correct. You do have to repay. You have to, I think you have 15 years to repay the amount into the RRSP. And if you don't, then it comes in as income. They'll treat it as if you don't if you kind of miss a repayment of 1/15 of the amount for 15 years. But that idea of, hey, if you're again young resident starting to work, putting it in, so again you get that upfront right off of the income, and then you can tax-free take it out and then repay it kind of over time. So borrowing from yourself instead of the bank.
Right. Now, okay, so that's very interesting because since we're talking about first-time home buyer, can we just dive right over to talk about the FHSP then?
For sure. So that's quite a new one. I think only a couple of years old. And again, the answer is right in the name, the first home savings account. So it's designed for people who have not owned a principal residence. I think it's like a 5-year test if you haven't owned one. And the idea is the FHSA is really unique. You get a deduction when you put money in, and most of these plans they have a certain sort of mirroring is the wrong word, give and take or so, right? So RSPs, you get deduction when it comes in, it's income when it comes out.
Mm-hmm.
TFSAs, for example, tax-free savings are the opposite. You have to put in after-tax dollars, but it comes out tax-free.
Right.
The FHSA
Oh.
is quite unique. I find that one a tongue twister.
It is.
But it's very unique in that it kind of merges the best of both of those. You get a write-off, the deduction when it goes in, but if you take the monies out and use it for an eligible purchase of a home, it comes out tax-free. And it will have grown in that account tax-free compounding as well. So for those who qualify, and again, if you have children who are going to be perhaps purchasing homes, again, helping them fund that account, put that in there, grow, take it out tax-free. That is a outstanding advantage, sorry. And I think it's currently $8,000 a year. You can put in up to $40,000. So, it can, the room accrues every year. So yeah, it kind of takes 5 years to max it out with $8,000 a year, if I did that math right. Yeah.
So that's independent, $8K a year, independent of RRSP.
Correct. It's its own, each one of these accounts is kind of its own thing.
So maximum 40,000. So hypothetically, if you plan this really meticulously, you can get 40K from the FHSP and 60K from RRSP. So that's 100K to buy a first home, right? It's not either or. It's not mutually exclusive.
Correct. Yeah. If you have the funds in the RRSP, and importantly, if you have a couple who are buying their, both of them kind of qualify of not having owned a home in a sufficient number of years, then both of them can withdraw from an RRSP. Both of them can have a FHSA that they can draw from. So again, like up to $200,000 of, very advantaged savings vehicles for people to save up for their first home. So there's different views on the political spectrum of, what's the best way to deal with housing, best to put lots of people's money in people's hands. Is it to control supply? But the government chose these tools of helping people save for the home. And I think these are pretty powerful tools. I think they achieve what they set out to do. So
they are, because homes are not getting cheaper, right? There's housing crisis, there's supply issue, there's credit issue, there's credit crisis. There's this all these stress tests making it harder for first home buyers. And then we now come to realize, like Vancouver, Toronto, Calgary, and soon Edmonton already is. It's harder and harder for young people to actually qualify. If they don't ever qualify for first home they forever rent, it's a different path than the rest, right? So this is important and actually applicable to our audience. It's a lot of international medical graduates, IMGs, and they're not young residents, but they landed here and they start from scratch and they haven't owned a home yet, right? This is all applicable to all of them, right?
Yeah, and again, a lot of these programs they have, in particular, there's a couple of ones we'll talk about today. The FHSA is one of them, where it's an account for a specific purpose. So the question is, well, what if I decide to not buy a home? I decided to just rent. I've done the math, and that makes sense for me personally. Well, there's options to kind of roll the amount into an RRSP, because otherwise the other option is taking it out for an ineligible purpose, which would be taxable. And I know we have lots of people who love real estate investing in here. I will perhaps cut off a future question by saying, can't use this to buy a place that you're then going to rent out. That would be, and I'm not familiar with all the stringent tests and how they say, you have to use it for this period of time and this and that. But again, they've got rules in there to stop it from being used to acquire a rental property.
Well, but then you can only have first home once.
Yeah, that by itself is a pretty big cap on it. But every once in a while, you hear people are like, "Oh yeah, I was saving up, but I bought one, and then I could rent it out, and I just rent the math worked out where I just rented out the one I bought, and I just kept renting the really cheap place I had."
Right.
So, but again, the accounts are not really set up for that.
Right. So okay, so that's useful. While we're still on the RSP segment there. So maybe we should talk about RDSP. What is that about?
Yeah, it's one you and I talked about in our catch-up call a couple of days ago, which was very interesting for you because you spend a lot of time in your practice filling out disability tax credit.
Tax credit, yeah, and a lot of our colleagues do all over Canada, disability tax credit, yes. So RDSP is Registered Disability Savings Plan, right?
Yeah, and the answer is right there in the name. So the focus of this one is on long-term support for disabled Canadians or Canadians with disabilities. So this is this one's been around for about coming up on 20 years. It was put in place by the Harper government. And the whole idea is, again, providing a vehicle to, again, help Canadians with disabilities save up for their retirement and future medical costs. So this one, again, once you get away from RRSP and TFSA, they get quite nuanced and picky with their rules. This is one where, so again, the get through the door requirement is that eligibility for the disability tax credit. So every person you've ever filled one out is kind of eligible to have a disability savings account. Now you can lose that privilege because some disabilities are temporary.
Right.
One can recover, and your account kind of gets frozen at that point. But the idea being, hey, once you have that, I'll call it the DTC, disability tax credit, you get access to the RRSP. So this is one where on the way in, it has to be after tax dollars. So that's kind of like the TFSA.
Yeah.
It will then grow tax-free inside the account.
Okay.
Now, this one gets very nuanced. So when money goes in, the taxpayer is kind of eligible for, I think there's a grant and a bond. One of them is designed really for low-income families, and the other is, it's always available, but it gets ground down with income. It's income tested, but there's always a base amount. I think it's $1,000 every year you can always get. If you put in $1,000, you get $1,000 match from the government there's a limit. I think it's up to $20,000. I should caveat this whole conversation with, I don't deal day in and out with these accounts. I'm not a kind of a wealth planner in that way. I'm very familiar with these accounts. I run across them in my tax planning, but some of the things are done from memory. So of course, anyone listening to this conversation will speak to their accountant, will speak to their wealth advisor, will speak to a tax lawyer, will do their own research to make sure that anything I said here is not taken at face value.
Yeah, well, but it's important. We do have attendees that have disabled children, some adult disabled children, right? And then every now and then you come across practitioners like that, and we all have patients that could benefit, right? So it's good for us to
I think the statistic of, the number of Canadians with disabilities, whether it's arthritis, whether it's reduced mobility as you get older, like, a failing eyesight, like, my old saying is, there's no such thing as everybody is just temporarily not disabled, because almost everybody, and you have a practice in geriatrics, you see people like, it's almost inevitable that you'll pick up something, a wonky hip, lost eyesight, deaf in one ear. Yeah. These bodies are not meant to last forever.
Yeah. Well, for young people that have a bunch of autistic spectrum, there's a ton of them, right? So
yeah. So this account, and I got real derailed there with my little impromptu caveat. Money goes in after tax, and there's these matching grants. How it works then is the amounts will then grow in the account. And when money is taken out, there's a formula basically to figure out what were the initial contributions that went in after tax dollars. Those get to come out. And then to the extent there's kind of investment growth or these grants and stuff that came out, those are taxed. But again, the idea being that hopefully at retirement, or again, person with a disability with low income, they're taxed at relatively low rates. So again, there's this mixed kind of quality of some is taxed, some is not taxed. But on the whole, the government matching makes it kind of a no-brainer, even though it's a little more complex than an RRSP. Maybe the advantages aren't as huge on that kind of upfront putting money in or the TFSA on the, total tax shelter coming out kind of thing. But the matching grants, and it's been a while since I looked at the math, but it's something like if you're in the, and this is important for the, people who are advising patients on potentially very low income, I think if you put in like $1,500, you get like $3,500 from the government, right? It's kind of like an instant doubling or tripling of your money.
Right.
Like it's hard to beat that. And again,
talk about maybe matching grants. So that's a good segue to RRSP.
And just to cap off that one, there are, of course, lifetime limits on all of these ones because there's grants for the RRSP. Again, there's lifetime limits on those. But again, fairly generous on the RRSP. And they've also, just to talk on it for another second, they've modernized their approach to some of the disability eligibility I know CRA used to be quite heavy with the rejection pen for a while, but in particular around mental health. I found, again, there's a bunch of rules and tests that in the Income Tax Act and the CRA applied, and the ones around mental health were very imperfect and a little archaic. And basically, again, not a medical profession, but it kind of had to be absolutely incapacitated. For example, a schizophrenic who couldn't even function at all in society. Like those were the only people with mental health conditions who were qualifying for the DTC. But they modernized it in quite a very favorable way, where severe depression and memory issues, and it's kind of a mix of these things they're willing to look at to say, like, yes, this person requires extra assistance to get through their days. And again, it doesn't have to be that person who's kind of like fully incapacitated and practically catatonic, which used to be the original kind of interpretation around mental health in particular. So that's good. It's a much more modern approach. And I just highlight that here because I know, again, I think some people, particularly anyone here who works in the mental health area, they may have just said, I don't even do them anymore because it's got rejected and rejected and rejected. But I have seen successes now, finally, for people with very deserving ones who have mental health who, again, didn't fall into that really severe category of, practically non-functioning. So,
So did I. Yeah. Good.
Yeah. So, but that's a good segue on into our ESPs, called Registered Education Saving Plans. Once again, the answer is in the name. The focus on this one is on education and saving up for future education, usually for children. I mean, technically, you can open the account anytime under, I think it's like the age of 30 or something. So, technically, you can start one later in life, but traditionally, parents are starting these for the children. Grandparents are starting for their grandkids, usually in the first 5 to 10 years of life. So these ones, they also have a matching grant program, not nearly as generous as our DSPs. I think it's 20% of a yearly contribution up to $500 of grant. So you can make a $2,500 contribution and get $500. Now, again, an instant 20% return on your money. You're not going to get that anywhere else. So whether it's $50 or $500, I'll take it. And again, you can get, there's a lifetime cap. I think it's around $7,200, $7,500, something like that, where you will, it all goes into the account. And you have to have a designated beneficiary. And that's the person who can largely take it out. And this one's a little more, most people who open a first home savings account will probably buy a home. It's very common in Canada, our home ownership percentages. On the other hand, our ESP, anyone here who has children, and Wing, you could probably attest to it. Roll of a dice. You couldn't tell me what any of your kids are going to do, or if you tried to guess what they were going to do at the age of 5, I'm sure you probably had a 0% success rate on what they ended up doing, right? So, so there are rules for those where, again, you can kind of roll it into an RRSP for the initial contributor. But assuming the kid does go to university, again, it's after-tax dollars that go in, so you don't get that same upfront deduction for FHSA or a RRSP. But those contributions then are kind of tax sheltered when they come out. And importantly, the income growth and the grants, they're taxed, but they're taxed in the hands of the student. So at that time, probably has nominal to no actual income, and so again, that's where your tax savings go. You've grown this nice lump sum of money over 15, 18, 20 years, and then it gets taxed in the student's hand. So,
right. So it's never too late to start. I think that's the advice, right? We started when our kids are a lot younger, when the program just got launched, and so we definitely reap the benefit. And then let's say the kids didn't want to go to school yet, go out to work, and then wait a few years, it's still there, right? And so it's always a good thing.
Yeah, I think it lingers around for you could have it open for 30 years until someone's in their 30. Again, I don't remember all the timing rules. I don't have children, so I've never had to interact directly with them. But yeah, it's never too late. A lot of provinces have two, call it jumpstart amounts, where if you just open one, they'll put in a couple $100. Which again, that's mathematically, it's an infinite return on your money because you put in $0, right? So again, the government's going to give you 500. Some provinces $500, right? They're going to give you 500 free bucks for each of your kids to plop into these accounts, and then give you another $500 every year on some match. Again, it's hard to beat that deal anywhere else. So again, I know some I've had some colleagues who have like 5 or 6 kids, and they're
Mhm.
it really adds up, right? So
It adds up. Well, when every dollar counts, even though people thought, well, physicians and healthcare professionals have high salaries, high income, but well, there's delayed gratification. We have so many years of tuition and the loss of income, and of course, student debts, right? So every dollar counts, right? So it's a win-win. Okay, so let's.
and again, if it doesn't go towards school, you get to roll it into your retirement account afterwards, right? So
Bingo, exactly.
again, I think there's caps on all that and everything, but yeah, so it's just another vehicle that you can. It's another tax advantage. Again, when you filled up your TFSA, you filled up your RRSP, all these things, the government has given you another way to save. And again, there's a lifetime contribution on RESPs that I can't remember off the top of my head. It might be in the. I'm just purely guessing, so I won't say it. But yeah, you can't contribute forever. And actually, I should circle back. Same with the RDSP. That one also has a lifetime cap. That one I think is $200,000.
Wow, that's quite a bit.
That's quite a bit more, which makes sense. Again, you're funding someone's retirement and potential long-term care into the distant future. So,
right. Well, okay, let's jump over to TFSA, which is slightly different than the RRSPs.
Yeah, that's become kind of the newest. Call it catch-all. It's the everything. I think it mirrors a couple of a concept the Americans have. I think the Americans have an equivalent to this. Okay, definitely don't quote me on this. It might be like the Roth IRA. Like this idea of a vehicle to, maybe it's not the Roth because maybe you can't take that out. But the whole idea of the tax-free savings account is it doesn't have really a designated purpose, right? We've got a retirement one, a disability one, an education one, a first home one. And then we've just got the generic tax-free savings account. So I've touched on a couple of its elements already where money has to go in after tax. Right? So you've earned money, paid your tax on it, goes in, no deduction like an RRSP. But the advantage is all the growth is tax sheltered. And when you take it out, there's no tax. How this one builds is every year the government is going to be giving you contribution room. It started at $5,000, I believe. It's currently up to $7,000. And so how it works is basically every year you're a Canadian resident and over the age of 18, you accrue room. It grows every year. So if you have, when year was it? It was like in the early or late aughts before 2010, it came about. So we've got kind of 10 or 12 years of it. In total, the current cap is sitting at, I believe it's 109,000. If you've kind of been a Canadian resident for, since that time period and you've never contributed to your TFSA, you have $109,000 worth of room at the maximum. So yeah, that's a lot of room and it grows quickly. And yeah, currently it's, again, I think the contribution room is 7,000. And I just found in my notes here, 2009 has been the account open. So if anyone has an open one and you've been a Canadian resident since 2009, you don't have to open an account to start accruing this room. It just builds there in the background. But yeah, you must be an adult, kind of 18, 19 to actually open said account. I guess that makes sense because that's when the room starts accruing. Sorry.
So when the time comes, you need to pull the money out, then what happens?
Well, the TFSA, importantly, there is no time period you have to take the money out. And there's no purpose you have to take it out for. So people do hold these for a long period of time and into retirement. And yeah, there's no tax when it comes out. So there are, however, some nuances because a lot of these accounts you're not going to be RESP. When you take money out to spend it on education, you don't kind of get to put that money back in. Same with RRSPs, FHSAs. The TFSA, they're not really designed for money going in, money going out. They're not normal savings accounts. Sometimes you can recontribute, but it is very limited. I mean, I talked about the home buyer plan where you take money out and put it in. So, of course, everything has an exception. But the TFSA is really designed for it in a way, right? It's a savings account. And I think that's what the government planned it for is, someone who wanted to save up for a car, right? Hey, it's a savings account. You can save up for a car, make that purchase. So the way the rules work, and this one got a little messy on the CRA because it's a little complicated because the name savings account is right in it. When it first came out, a lot of Canadians misunderstood, and I think a lot of institutions probably poorly described it to people. People were moving money in and out of the account multiple times in the same year. Basically, how it works is, let's assume someone you've never contributed and you open up a TFSA tomorrow and you put in $100,000, right? Because you want to save up for a house. And then later that year, you say, you know what, actually, I want to buy a car. I'm going to buy a car instead. So you take out $40,000. The way the TFSA works is you're allowed to recontribute that $40,000, but in the next year, it gets added. So they kind of rerun the math and say, okay, what's the new? So in the next year, they'll say, hey, what's the new contribution room? So again, it'll be $7,000 again, or $7,500, whatever it is. They say, oh, but also you can add to that amount any withdrawals you made in the prior year. And why people got caught on this was people didn't know that. And so people were withdrawing, contributing, and just using it as a normal savings account. And so they kind of didn't have enough accrued room because it didn't get added till the next year. There was then kind of a penalty tax that was applied. And I think the CRA actually, in the first couple of years, may have had some clemency and forgiven some of that because there was such a poor understanding of how the account worked. But very important, if you take money out of a TFSA, you can add it back in, but only in the next taxation year.
Not the same taxation year.
Not the same taxation year. Yeah. Unless you still have contribution room, right? But you don't get that. So again, if you had 100,000 of room and you put in 50,000, and then you took out that 50,000, I mean, you still have 50,000 of contribution room from the original. You had 100 to start and you only took up 50 of that, right? But that 50 you withdraw, it gets added back into your contribution room in the next year. So, and that's again, and it's interesting. I think the TFSA is one of my favorite savings tools. I discuss it a lot. I just think I think the government did think, oh, people will use this to save for a car, to be supplementary savings for education, things like that. But I think a lot of taxpayers have realized this is a very powerful tool, considering you're never going to get taxed on the withdrawals. You have this tax-free growth. And importantly, example for RRSPs, there's an age limit. At the age of, I think it's 71, you have to convert it into a registered retirement income fund, and you have to start drawing it down, and you have to start taking that in. And there's a whole formula on what percentage you have to take every year because they want it drawn down. TFSAs, there's no rules like that. It can go on in perpetuity. And again, when you die, if it's grown to a big number, it'll come into your state, but it won't be taxed on it. It'll be
so unlike RRSP, TFSA is tax-free to the next generation, or to the estate.
Yes. Yeah. So they get this nice lump sum of money with no extra tax, all in the RRSP. So I don't think we've seen the full impact of it on kind of the transfer of wealth because it still hasn't been around long enough. Right. I guess 2009, like we're talking 15 years now. But there's going to be a day where, people who have had TFSAs for 50 years that have grown to probably 7 figures plus. In fact, I do know there's already 7-figure plus TFSAs out there from some very aggressive investors and who hit it big on some stuff. So, they're a fantastic tool. And again, I don't need to talk about it too much. I think most people do know about tax-free savings account. Probably most people on this call know about it. So
I think knowing about it and acting upon it is two different things, right? Most people thought about it, they may not act upon it. And I've done some iterations in my previous teaching sessions. If somebody started at age of 18 and started to faithfully put money in every year and start compounding and then take it out, by the time they reach like 45, is like a nice mid-6-figure portfolio, right, with the compounding, right? So don't underestimate that, because if you have a younger kid and say you coach them every year, get a McDonald's job and save 5,000, right? By the time you're 45, you might have more savings than most average Canadians, right?
Yeah. So I'm a fan of, the big question usually every year is, hey, RRSPs or TFSAs? What's best, right? And a lot of that is
hear that a lot.
It's a personal preference question. It's a question for your investment advisor and your wealth planner. But the rules of thumb, because we don't want people to leave here with nothing to think about, is oftentimes it's a question of, hey, where am I at in my career? Am I in a lower tax bracket? Then absolutely something like the TFSA, because the deduction doesn't mean much to you, right? You should be saving your deduction room for those years when you're going to be in a much higher bracket, because you can catch up, right? That the RRSP room you accrue doesn't go away. It just builds up. So you can kind of, for lack of a better word, save it up and use it in later years when you have lots of income and you're And more of that income is getting diverted towards retirement savings anyways, as opposed to a TFSA. Like, yeah, if you are a younger physician, younger professional who's interested in saving, but you're not, and you're kind of willing to sacrifice and put money away for the future, TFSA may be a better option because, save the deduction for later, put it in the TFSA. And again, if you are in that bracket where you're trying to save aggressively, but you don't have as much income, well, you might need that money in an emergency, and the TFSA is much more forgiving for taking that money out, whereas the RRSP has withholding tax and all these things, and it comes in as income if you withdraw from the RRSP. So if you get too aggressive with your saving, put it in an RRSP, and you need it back, it can be very difficult and expensive. But if you put it in a TFSA and, hey, I need the money back because there's an emergency, that's a relatively painless process. So
right, yeah. Plus TFSA, you can put into more volatile stuff or higher returns. If you expect that, right, then, for example, some of the commodities for us, we put into a TFSA, right? And because I can pull money in and out anytime, right? And same for our kids, say, hey, you might need to go back to school, pass your student loan, what they allow you, or you want to buy a car, start a business, right, buy a house, right? On top of the FHSA, all those accounts, you can still use it for anything. Or you need to move away, right, and start yourself somewhere else, right? So that's always good. Now, that's really good. Now, the last couple of minutes, let's talk about some nuances about more complex things like spousal RRSP. What is that?
Sure. So the spousal RRSP it's not uncommon now, but it's not as useful as it used to be. So the whole idea is, again, RRSPs generally, you put in money, you get a deduction, you take it out later at a lower, when you're in a lower tax bracket. The idea of a spousal RRSP is, say you have a two-person household, one person works, one stays at home. The one who is working and accruing the RRSP room can open an RRSP in the name of the non-working spouse and make contributions into that one. That account is owned by that second spouse, but the deductions are taken by the earning spouse who's making the contribution. So there's no change in the deduction. If you make a contribution to your own RRSP or a spousal RRSP, you get a deduction. Doesn't matter which one you contribute to. The point of the planning would be to have some kind of income splitting down the line. We've got this spousal account in the other.
When you turn 71.
Yes. Yeah. So you have this, you have the account building in the other person's name, and they can take it out. And so again, the whole point was to give some kind of pension splitting treatment for income splitting treatment for retirees. Now, there's actually other rules in the Act, and why I said, hey, it's not as common as it used to be, because there's now rules that kind of allow you to split RRSP income between retirees anyways. So they've fallen a little bit out of the way, but if you're in a field or a profession where you feel like, hey, I like to move assets out of my name, even though RRSPs are usually not subject to some of the bad rules people might come after you for, hey, it still might make sense to have a spousal RRSP. It's an easy mechanism to put that future income into their hands, especially if you,
Now, of course, that dives into a bigger topic called IPP, right? It's kind of an RRSP on steroid for incorporated professionals. So that there's a lot more to it, but we won't have time for that tonight.
Yeah, and I think we've definitely had master classes on them. We probably haven't dedicated a podcast to them, but very interesting concept. Yeah, very nuanced. Doesn't work for everyone. When it does work, it works great. And it's kind of an individual pension plan. It's a kind of a very specialized. It's not an RRSP. An RRSP is a very specific designed thing with its own sections in the Income Tax Act. An IPP is inspired by RRSPs. Yeah. Right.
Okay, so we'll leave it at that. Thank you very much, Jason. I know you're really busy, especially this is tax season. A lot of people need to crunch in all these registrars funds before March the 2nd. And thank you. It's a really busy time of the year for you.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at physempowerment.ca, PHYS empowerment.ca, to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend. and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@phisempowerment.ca. Thank you again for listening.